Good morning. I'm Afsaneh Beschloss, CEO of the Rock Creek Group. Thank you so much for joining us for our quarterly global market discussion today. I'm in our Washington, D.C. office with three Rock Creek senior advisors, Dr. Alan Greenspan, Dr. Laura Tyson, and Dr. Liaquat Ahamed. In its latest Global Financial Stability Report, the IMF just came out warning that good economic times are masking very long-term risks, particularly the 135 trillion in debt among the G20 countries. Do you agree with the IMF's conclusions right now that investors are being too complacent about long-term vulnerabilities?
I do agree. That doesn't necessarily mean that it's now. I mean, we want to distinguish between people who are investing and people who are forecasting what's basically going on. That the longer term is a very difficult problem, I think goes with saying. But that is not the same thing as saying it's right around the corner.
I'll say two things about it. I do think that longer term problem should be having more effect, and it isn't, on the discussion in the US about tax cuts. It's not really a discussion about tax reform, it is about tax cuts. And we're looking at tax cuts that at a time when our revenue as a share of GDP is much lower than it was under Reagan and under Bush. So we're starting with a low revenue base for the federal government as a share of GDP, and the debt, of course, the GDP ratio has gone from 25% under Reagan to 77% now. So we need to take this debt into account as we make policy now, and I don't think we're doing so. I'll say one final thing. A lot of the G20 debt is also picks up debt in China, and I think we should treat that differently because of the very high savings rate in China, and because all of the debt in China is basically owed to China itself, and because the Chinese government has very different macro-prudential and other policies to handle its debt.
Asset prices are high, but not irrationally high. And I think the high level of asset prices all stems from low long-term interest rates. That's what's driving it all. And if that were to change, you could see this whole thing begin to unravel. But there's no obvious reason why long-term real interest rates should begin to rise. There's productivity is low, productivity growth is low, inflation is not a problem, and so I think this benign environment continues for a while.
Can I ask you a question, which is, do you think that the normalization of Fed policy or UK Bank of England policy will change that? I mean,
I think it all depends on the pace. I mean, the striking thing about the whole normalization process has been how measured the Fed has been in normalizing rates. And probably rightly so, given that there's been no inflation.
And I think the issue of the longer term debt is, remember that what debt is it's a rigid hold on flexibility. I mean, what a corporation does is to try to keep its debt down basically so that it has ability to function. And we're getting to a point now where things are not looking all that well, and certainly in the federal sector, which is ultimately a critical issue, because if that gets too bad, they spill it off onto the private sector, and that's where you have a problem.
The traditional relationship between employment and inflation may not be there anymore. The way we were all trained as economists about the Phillips curve.
It's never been relevant in the sense that it works all the time. I mean, so you can't talk about the Phillips curve without specifying what you're talking about with respect to Purdue.
the Phillips curve always was a rough approximation to reality, and certainly the timing of the relationship was uncertain. You know, when does the unemployment rate trigger inflation, when does it not, how long does that take? But now we have the problem that we may be mismeasuring labor market tightness. Labor markets are certainly tighter. We may be mismeasuring the ability of the workforce to actually create from labor market tightness wage increases because of the structural trend of automation taking away employment intensity, and we may be mismeasuring productivity. I completely understand, therefore, why Chairman Yellen will say there's so much uncertainty. The thing I think we need to do is think, yes, over time the normal relationship between labor market tightness and inflation will occur, but I'm going to go really slow.
I actually still buy the low inflation story for the reasons that Laura was just describing. I mean, I'm acutely aware that there is a risk that all of this is wrong and suddenly we're going to get an uptick. But if I was a policymaker today, I would be willing to take that risk and to allow this growth more headroom and keep interest rates low. So at the moment, the projection is that they're going to raise rates by 50 basis points over the next year. That's tiny. And I think that's a very reasonable forecast.
So the big elephant in the room is trade. Obviously, there's been a lot of talk about NAFTA.
Can I just raise an interesting issue which nobody wants to talk about? When NAFTA was put together, it was very purposefully skewed in the direction of helping Mexico.
Yes.
And the reason it is that I was part of the negotiation, so I know what was happening, saw that an improvement in Mexico would really help everybody. And indeed, it has.
Indeed it has.
And why we're complaining here about it worked out to, well, they got a better advantage. Well, I should hope so. That's what we were trying to do. It was our judgment that if Mexico does much better than it was doing, and it was doing poorly, we would benefit.
Isn't the theory of the case of this strategy the sort of Bannon nationalism, which is it may not be great for the economy as a whole, but it's going to be good for unskilled workers in the U.S. Their calculation is that a shift towards a more aggressive stance on trade and protectionism may not increase the size of the pie, but it's going to help our base.
There's a lot of focus right now on will there be a tax cut, and I'm going to say cut because I don't think there's much reform in this thing, and will that be positive for growth? I don't think we're talking enough about the negatives for growth that could be introduced if we pursue and succeed with this unraveling of our trade policies with our three largest trading partners. This is very negative for growth. So we've really had a period of globalization that has very much worked to the relative benefit of emerging middle classes and emerging markets. It's actually hurt, particularly I would say the middle skill manufacturing worker in the developed countries. And they're part of this base. And they also see the immigration being a threat to them in services and other things. This is a long-term problem, and I don't actually see it being easily addressed, because I actually think, so let's say tax cuts, let's go to the markets again. So tax cuts are expected. It's expected that they'll boost investment. It's expected that that will boost growth. How much of that investment will be job creating? Well, if a lot of it is basically skill-intensive or labor-displacing investment, a lot of companies can move to the technological frontier in digitization, not hire too many workers. So we may get some investment, but the employment effect may be actually quite small.
I remember asking you long before it was in the newspapers, what is the biggest risk facing us? And you said North Korea. Obviously, it still remains a risk. At the same time, the relationship between North Korea, US, and then the whole Chinese role in it is getting more complicated. This sort of complicated web, do we need to worry about it?
The first thing I would do is start to worry. That's an easy thing to do. and I would go back and look at the beginnings of World War I. What was fascinating about the period is nobody thought that a war could take hold. Why? Because they would run out of gold and they would not be able to fight.
Right.
And that, to be sure, Europe was in a little sort of disequilibrium, but nobody took it seriously. Once a war starts, it builds. What bothers me is exactly that issue. That is, we can sort of be fighting with each other at the edges and say, well, nothing is going on that's very important. It's all just a bunch of talk. And the problem is that somebody will do something stupid.
There is a significant part of U.S. foreign policy thinking, both within the administration certainly, and even in the Congress, that we have to stop North Korea from becoming a nuclear power. And then there's a serious view that too late, can't do that. All we can really do is contain it and management, and we better stop making policy on the grounds that we can divert it. I think this is a containment issue that I think we would be better off just accepting that because it's a reality and then saying what should our policy be under those circumstances.
By the way, also talk of maybe cyber war.
I think the dilemma for markets is what do you do when you have a very low probability disastrous event? How do you incorporate that in?
Well, that's the fundamental issue of policy, is how to weight various probabilities. And we've got very few tools which are sophisticated enough to do that as well as it should be done.
I mean, I don't remember the Cuban Missile Crisis because I was a kid, but I don't think markets went down that much because people said, actually, I've got a lot more to worry about than the value of my portfolio. That if this whole thing blows up, there are many more important things.
I think we have a bond market bubble.
Okay, let's
In other
talk
words,
about that.
remember that low interest rates means that the price of the bond is up here and the earnings are down here, and if we crossed out bond and said stock, we'd all be shaking.
The only difference is a bubble usually occurs when you're buying something, thinking it's going higher in price, and you're going to sell it to a greater fool. And I think the problem with the bond market is, I don't think that's why people are holding bonds. It's because they can't think of what else to hold.
I think it's a mistake for us to look at debt GDP ratios and say that China is headed for a crisis. I actually think you have to look at all the tools, and I think that they have slowed down the generation of new credit, but they did a non-performing asset correction back at the beginning of the 2000s. It was massive, okay? That was basically the government coming in and saying, okay, there are a whole bunch of non-performing loans in our banking system, let's clean it out. They did it once, they can do it again.
But in effect, the Chinese market has done so extremely well this year. The Hong Kong market has done extremely well. Their tech companies have done incredibly well. And there's still a lot of growth left in there.
But ultimately, the Chinese growth strategy has not changed dramatically.
So they said they wanted consumption as a share of GDP to rise and investment to fall. That has happened. The investment rate is still much too high, but you've actually seen that line cross, and that was people thought they can't do it, they did it. The services sector has been the major drive. So consumption has been the most important driver of growth in China for the last few years. And within consumption, it's mainly been consumption of services. So that is really quite remarkable. That is a shift. I personally think China has a huge infrastructure investment opportunity to take those completely smog-ridden, pollution-ridden cities and transform the infrastructure. And they say that they're moving to an alternative energy future. They've set a date. I think they can do it, and I think that will require a lot of new investment, but I applaud that investment.